Yes or no? Does this budget solve intergenerational unfairness? The game has changed, but the game is not over. You know what I mean? Hey everyone, welcome back to another Pathway Property Podcast episode. Today we're going to be talking about the federal budget, and don't worry, it's not just going to be a regurgitation of facts. There's 101 podcasts already out there.
This will be a bit spicy.
A little bit spicy, you know what I mean? I mean, it's always spicy when it's us two. It's like Mongolian beef, but authentic Mongolian beef.
With fennel.
You know? With fennel. So, it's not just going to be a regurgitation of facts. The facts are out there. In all honesty, jump on ChatGPT, jump on Claude, or even just ask us. We've sent a video to a lot of our clients, people in our network. Today, we're going to be getting opinionated. We're going to be talking economics. We're going to be talking politics. But more importantly, we're going to be talking about strategy and what this means for people trying to build their wealth moving forward, right? So we'll be covering a lot of that. We will do a quick summary of the facts, but before we jump in, most of you are already familiar with Nirvan. Nirvan, do you want to quickly say hi?
Yeah, obviously, my name's Nirvan. I'm co-founder of Pathway Property, head of acquisitions. So I'll take you over the acquisitions team. Basically, we're dealing with the most exciting part of the whole story, which is actually getting the investment property for our clients and working on those. But let's get straight into it.
It's not a really spicy introduction. I thought everyone was expecting spicy, but I'm just having a laugh. And other chair over here, we're supposed to have Albo over here because now apparently he's a founder in our business, but couldn't make it.
I'm actually sick of that. Like I don't know if people know what you're referring to, but there's like this meme going around like. Yeah. I've got a new 47% shareholder. It's been making the rounds, but
there you go. Yeah. Let's do a quick summary. So before we get into the opinions, what it means for the market, how things are going to change in the broader Australian economy. Obviously, a lot of this right now is based on studies, but there is an element of it that's speculative, right?
Yeah.
We will only see things happen and collect the data over the next 3, 4, 5 months.
Yeah.
But speculation is part of the process.
Of course. And also, like, the enabling legislation hasn't been passed yet. So there may be some changes that come into effect.
It'll be interesting to see because, like, some of it will just be passed. Because if Labour work with the Greens, they have an exact majority, right?
Yeah.
But then who knows if they work with the Liberals, they could be pushed in a different direction.
But the thing is, like, they've taken a bit of a hit, like, on the public forum. So I wouldn't be surprised if there's some tweaking of what we've got. I don't think it'll be like anything that is sort of one of those headlines out there, but there might be a bit of tweaking in the legislation itself. But we'll see what happens.
There you go. Okay, let's start off just with a quick summary of the facts, right? So I guess there's heaps of stuff that have been changed in the budget. Yeah. Electric vehicles, NDIS.
We'll focus on property.
All of that kind of stuff. We're going to be talking mainly about property-related facts. So changes to capital gains tax, changes to negative gearing, right? Those are, I guess, the two really big ones. And then changes to trusts and the way they function and distributions around those. Yeah. Do you want to give just quick, like, try keep
let's
keep
each
of
it
them
nice
under
and
a minute.
Yeah, 100%.
Summary on all three of those. What's changed?
Yeah, 100%. So I think the first and the biggest headline has been the negative gearing component of it all, right? So negative gearing is essentially like the difference between the rental income you make on investment property and the mortgage repayment that you have. If you're negative on that, so if your cash flow is negative, you can deduct that from your income tax at the end of the year, right? At the end of the financial year. That has been now scrapped entirely for properties that were purchased essentially after the budget was announced. And that means now the people who had a property before that point can now continue to negatively gear, essentially get that off their tax bill. But those who purchased the property after that point, they can't, except if you buy a new build, right? A new build means basically a newly built constructed house that hasn't been occupied for more than 12 months. Your house and land package is off the plan, new build just in general. But one piece that is often forgotten is the fact that you can still offset your losses, and we'll get into that in a second. Just want to hit the quick facts about negative gearing per se. You can still offset your losses against other income that you make from the property itself. And it seems like also from other residential properties that you have in your portfolio under the same structure. But we'll jump into that in a second. The second thing that is also the biggest headline that's come out is the changes to capital gains tax, right? So Capital gains tax is essentially when you buy an asset, it grows in value. Let's say you bought something for $100, you sell for $200. The difference is $100, right? So you made $100 of capital gain. If you hold that property for more than 12 months, this has been the golden rule of investing for the last 25 years. You get a 50% discount on your gain. So that means instead of being taxed on $100 that you make from that capital gain, you get taxed on $50. Now that is going to change entirely, and it's going to go back to the system which it was half or quarter of a century ago, which is indexation, right? So we're going to be using inflation to determine whether how much your actual gain has been, which is called real gain, right? But again, the nuance here is that, and this is sort of a theme throughout the entire budget, it incentivizes and it gives that option to new builds. Right, so if you buy a property that is a new build, you can choose between the indexation and inflation method of discounting your gains, or the 50% discount.
Mm-hmm. And then trusts, what are some of the major changes?
So on the point of trusts, there has been a change, which is obviously trust structures have been used for quite a long time to minimize tax by distributing, especially, and this is mainly for small businesses and family-owned businesses in a lot of the cases. Like most of the trust setups I know for the people we work with, they're usually like family businesses, right? So they use that mechanism to distribute the tax so that the person who is sort of the key income earner isn't taxed and penalized at the highest tax rate. They can distribute that money to, a spouse, a parent, a child over 18, etc. Now, instead of that distribution working in accordance with whatever marginal tax rate each individual person is under that trust setup, now it's going to be a minimum 30% tax, right? So that means your distributions that come out of the trust will be taxed 30% no matter what, at a minimum, right? So that'll impact you from a property perspective because many people hold properties in trust, and if you're positively geared on those properties that you hold in there, you can't distribute without being hit with a minimum 30% tax.
There you go. Okay, beautiful. So we got the facts out of the way. Negative gearing, can't negative gear on any properties after you bought from May 12th, just for like the next 12 months you can, and after that you can't, but you can hold those losses and claim it against future property income. But you have the grandfathering. Why do they call it grandfathering? Like, I mean, I've been hearing everyone say that name, but it's like, maybe why not grandmothering? You know what I mean? Why does it have to be grandfather?
I don't know. I think it may relate to some concept about, let's say someone gets like orphaned or something, and then I don't know. That's the theoretical thing I'm thinking about, but I don't know.
It'd be interesting to look at where that term came from. Exactly. Grandfather. Where
it's an interesting one.
Yeah, but anyway, so it has been grandfather, and that's been, I think that's the Greens hate that the most. I think that's the part that because it's like, okay, all these, people who've already got 8-9 properties, half of our clients basically. Like, why aren't they being punished? It's just future investors being punished.
Which kind of cuts across this idea of, making this.
Yeah, the whole
keep saying like intergenerational fairness, which is kind of like it counts. It goes counter to that.
Exactly. Then the second thing, just capital gains tax, right? Being changed from the 50% to the new method, but for new builds you can choose, and this is across. I mean, as of now, it seems like it's across all asset classes, not just property, right? And then lastly, changes to the way you can distribute trusts. But I don't think we'll be talking about that too much today. That's probably more a chat for our next podcast when we have one of our brilliant financial planners.
There's probably a chat for an accountant and financial planner.
We'll probably do an episode on that specifically. I'm in Sydney next week interviewing one of our high-level accountants, works with a lot of our investors, so we'll be talking trusts. A lot of people are now talking about buying property under companies, so on and so forth, right? Yes or no, does this budget solve intergenerational unfairness? And we'll get into why shortly, but if I throw you on the spot and I'm asking you to give a yes or no. You're a lawyer, so you're going to say it depends, and we have to. I knew. I was just having a laugh, and like I
look,
hate yes or no questions.
First and foremost, I don't want to take you like it takes a lot of courage to do something like this as a government. Like it's sometimes there's a lot of government that lacks leadership, but they've actually they tried to do something about this, I guess. But I don't think the way that they've done it is going to yield in the result that they were going for. And there are reasons for that. There are reasons for that. They're trying to please everybody, right?
Yeah.
And obviously, it's all about votes at the end of the day.
Yeah.
So they're hedging their bets. So I would say no.
Yeah, there you go. No, I agree 100%. I do kind of like that they did something, because in reality, I mean, people in Melbourne and Sydney might not have seen. I mean, people in Sydney, they've been living with this their whole life, like unaffordability of housing. That's just like
a fact of life.
That's just a fact of life in Sydney. Melbourne, it hasn't been too intense over the last. So like Melbourne is like it's always been like a steady growth market, right? And even now, like I think one of the things with Melbourne is there's so many directions that land can be developed in. So even if you can't get certain corridors grow really well, but if you can't afford in those corridors, there's always other corridors that you can
100%.
go to, right? Like you can go to the western suburbs, you can get something you can get like a 4-bed, 2-bath in the 700Ks.
Exactly.
Out in the west. Obviously, and it's like 45 minute drive from the city.
Yeah.
Yes, there's not much infrastructure and stuff there, but you can't do that. You can't even do that in Adelaide. It may be in like Adelaide northern suburbs. Definitely can't do that in Perth. Can't do that in Brisbane.
I think out of this horror story that is the supply shortage in Australia, probably Victoria and Melbourne is like, okay, we're talking relative here, right? They're not doing a great job as a whole, but it's probably the most sustainable out of all the capital cities in Melbourne.
Yeah. No, and I think like when you look at like Perth, Adelaide, Brisbane, the growth over the last 5 years is it's not sustainable.
No, it's not.
You know what I mean? It's like 20% annualized growth. Amazing for investors, but it's like we have a Facebook group about Perth properties. And there's like 50,000 people in there, and it's like a lot of the posts are like people just feeling defeated, right? So I kind of get
it's tough, man.
I kind of get the necessity for this. You know what I mean? It's a necessity for doing something about it. 100%. One thing I often say is like within the property space, I feel, especially in the buyer's agency phase, I feel like I'm one of the most left-leaning people. That's not saying much because I feel like everyone in the buyer's agency space are economically a little bit to the right, which not a problem, but there needs to be like, yes, you can use property to build your wealth, but it needs to be sustainable for the economy. I mean, we have like multiple home buying buyer's agents, right? As a business, and so we don't just work with investors, we work with a lot of home buyers. And we see the struggle they go through, and the economy needs to be structured in a fair way. But let's talk about if this is fair, because I guess they were trying to do that. Did they actually achieve that? So like let's maybe start off with negative gearing being dropped completely to zero properties except for new builds. Do you think that's going to achieve what they wanted to achieve, and do you think that that's fair?
So when it comes to the negative gearing, the fact that it is grandfathered obviously is by the fact of that unfair to people who purchase properties after that point, right? So that is one point where it's a clear distinction between pre and post budget purchase, right? And basically, if you want to think about it from a generational perspective, people who purchase pre-budget are all the previous generations, right? And people who purchase post-budget are more so the newer generations. It probably hits more the aspirational middle class in Australia than it does the wealthy. And if they really want to go after the wealthy, they could.
I mean, the wealthy don't even buy in their own name.
No,
a lot of them
don't.
they buy under trusts, companies,
Exactly.
3 companies holding a trust.
They have very sophisticated structures. So what they're doing here is they're causing hurt to small businesses. They're causing hurt to aspirational middle class people. And by taking away negative gearing entirely, like I would have like from some of the commentary that was coming out, it was like potentially 2 properties, which again, that still takes away the tools that previous generation had. but it still makes it sort of reasonable because at least there's even if they change it on a future date and they might just remove negative gearing entirely, keeping it at 2 at least presents a more fair playing field. But taking away entirely is a little bit, it's a bit too much.
I agreed. Like, I literally said the same thing. In fact, like, one of the things I was talking about, even way before this budget, one of my friends, he's not in the property space. He plays in, like, other spaces. He's doing well for himself. And he's, like, a lot more left-leaning. And he's, like, rage against the machine. Like, what's happening with property? He's like, Arshad, you're destroying everyone. I'm like, bro, relax. Yeah. But, he was like, okay, Arshad, what do we do? And way before the budget, I was like, what we need to do is incentivize new builds, right? Create that incentive for investors over established. So I think this kind of does that. But I do think it's like pretty much exactly what you're saying, right? It's capping it at 0 is punishing new migrants, punishing young investors,
100%.
Punishing mom and dad investors.
100%.
It's not punishing, I can guarantee you, it's not punishing the guy who has a $10 million portfolio, the guy who's making $1.5 million a year and has like heaps of tax.
You know who else it's punishing? It's punishing renters. So like now with the way that rents are structured now is obviously negative gearing comes into effect. So that means the landlord can absorb that loss, right? Now that means either the landlord will push that cost onto the renter, or they just wouldn't buy an established property. So that means we already have a rental shortage as well. So that means rents are going to go up. And they give some like delusional figure of $2 per week, which I found that a bit outrageous. Like it's a bit like removed from reality, I would say. There's a lot of smart people at Treasury, I'm sure, but it is a bit removed from reality. So that's going to have a ripple effect into the rental market more generally. And I think a lot of people on the other side of politics where they're saying, okay, we just need to abolish every sort of incentive and, they're more so sort of the city dwellers, renters, etc. Sometimes I think they might miss the nuance that the only reason why rentable properties exist is because the person who's renting it out is a property investor, right? There's a landlord in place that is offering that opportunity. I'm not saying there should be people owning large amounts of property and just hoarding the rental market, etc. But it's quite democratized the way that it is in Australia as opposed to other countries.
Yeah. And at the end of the day, the other thing is it's not a closed system we live in, right? It's like there is a very real danger of capital flight, right? That money leaving Australia and going to Dubai or wherever. I don't know. I'm not an international market
Panama,
guy, right?
Bali.
But there's always the capital flight is a reality,
100%.
right? And you see that happen in a lot of places where, especially you can see that happening in a lot of places in Europe right now.
UK had like a major flight of capital out of
right?
Out of
and that capital flight decreases the economy, decreases the amount of available jobs, all of that kind of stuff, right?
100%.
Now, we talked about, I guess, it makes it a bit difficult for early stage investors. And keep watching the podcast because while it does make it a bit harder, it doesn't make it impossible. There are still strategies and solutions. We're still, it's funny, after the budget, like up until the day of the budget, I was a bit stressed. I was like, because obviously at the end of the day, I'm a business owner as well.
Yes.
We're business owners and
property investors.
And it's like we have employees and we're like, okay, what's going to happen now? Are we going to have to downsize? Are we going to have to let people go? What's going to happen to us? So I was a bit worried. But then after the budget, like we actually had an increase in inquiries, right?
Yeah.
People were more like, okay, the game has changed, but the game is not over. 100%. You know what I mean? It's not the final whistle hasn't been blown.
Correct,
right?
Yeah.
It's just okay. It's like when you're playing soccer as a kid, and then some kid comes in and says, "Actually, now we've changed the rules. You can't do this anymore." And you're like,
they increased the football pitch
like a
size.
Corner, something like that, right? But that's basically what's happened, right? It's like half time, the referee has come and said, "Okay, now what we're doing is the other team has 2 goalkeepers." Right? It's like It's like, okay, bro, like what the hell? But it doesn't mean it's impossible to score, right?
Yeah,
I don't know where this metaphor is going, but I hope it makes sense for those listening at home. So anyway, but we'll get to that, right? The point that I was making is, so we talked about like, early stage mom and dad investors and some of the struggles they're going to have from a cash flow perspective. With the renters, it's an interesting one, right? Because I guess this is something we're going to have to see play out. I definitely do think so I see a lot of people saying, okay, how like, what are the mechanics of this? People are saying that rents are going to increase, right? Like, what are the mechanics of this, right? And I was looking into it because this actually happened in New Zealand, right? Like, it's like, you don't even have to, we have, I guess to a certain extent, a live experiment that happened just next door.
Exactly.
I mean, it wasn't like a double blind, all of the things were the same, right? But at a base level, what happened in New Zealand was they scrapped negative gearing, rentals just went up so high that they ended up bringing it back, if I'm correct, right? Like, and then that market pivoted, changed a little bit, so on and so forth, right? Now with rents in Australia, I think what's going to happen is there's going to kind of be like two markets, right? Your established suburbs, right, rents are going to increase drastically because there's going to be less rental listings available because there's going to be less investors, right? There's going to be more home buyers absorbing stock, and good for them, right? But that also again means less rental listings available. So your inner suburbs, let's say if you're in Adelaide, you take a suburb like Morford Vale. If you're in Perth, you take a suburb like Morley, right, or Currumbine, right? If you're in Brisbane, think of a suburb maybe like Deception Bay, right? I think these suburbs, the rents are going to pump really high in the short term, right? And then obviously they'll stabilize, but there will be a short-term pump over the next 2 to 3 years. On the other end of things, I actually think your new estate suburbs, which generally don't see crazy rental growth, they see like very average rental growth. I think that average will actually be slower as there'll be more investors going there, more rental supply. 100%. Now, this isn't a fact, it's a speculation, but I think that's how the renters will work. But at the end of the day, most renters, they don't want to rent in, Wyndham Vale, right? They're like, if I'm going to go all the way out there, I might as well just buy a house, right? Not to say everyone, but generally most renters, the reason they're renting is because it's like, okay, I really like this suburb. I want to be in a place that I can't afford a house. I love Brunswick, like I love inner North Melbourne, like I want to rent there, but I can't afford a property over here, right? Even rent vesting is huge these days, right? I think like especially over the last 5 years picked up. So I think that's how the mechanics of that work. But it'll be interesting to see how that plays out for sure. Because at the end of the day, landlords might be annoyed and they will use their annoyance. Is that a word? Let's say it's a word. They'll use their annoyance, right, to want to push rent up. But at the end of the day, if there's available supply, the people will just move out and go somewhere else. So those markets where that supply is not available are going to get hit pretty hard from a rental perspective.
Why don't we talk a little bit about like the implications to the way that we do property investing now, because the playing field is now different. The structures in place are different. The way that you need to structure, the way that you need to select assets, the area selection is all going to look quite different, right? Because of these new variables that are in place, which is fine. It's just part of there was an old set of rules and now there's a new set of rules.
Yeah,
right?
and that's always been changing, like if you look at 10, 15 years ago, the investment philosophy was always like, blue chip, Melbourne, Sydney, like homeowner suburbs. Whereas I think around 2018, there's this massive, probably more started in like 2019, this massive affordability run, right? Like suburbs that people would never buy in. You think of like Armadale in WA.
Because they were lagging
they were so
much.
Undervalued, right? The yields were high. They were so undervalued. Affordability, there was massive regional run as well, right? Like the 2020 to 2025 regional run, like regional Queensland especially, it's like insane. It's like insane. Like getting, like, we were buying stuff like 7.5%, 8% yields, right? duplexes, you're getting both sides of the property for like 400K. Insane.
Yeah.
Right? And those are all like doubled in value, probably even more than doubled in value, right? So there's always this shifting. It just happens, right? Like, you know, a lot of people at the beginning of the Melbourne cycle, they were like, oh, Arshad, Melbourne hasn't grown in 5 years or hasn't grown much in 4 or 5 years.
Yeah.
It's like, that's not a bad sign. If the demand and supply looks good, that could be a good sign. At the beginning of the Perth cycle, Perth hadn't grown in 10 years or something like that, right? Like a crazy amount of time. So looking at the fundamentals is more important.
100%.
Now, in terms of, I guess, what it means for the market, it'll be really interesting to see. I think a few things, right? I think number one, and this goes again back to another loser from the negative gearing change. Another major loser in the negative gearing change are first home buyers that are looking in a lower budget.
Yep.
Right? I think first home buyers actually think the biggest winner from all of this is first home buyers with mid to high budgets. You know, like I'd say 900, maybe like 800 to 2 million, 900 to 2 million, right? Because the amount of competition they're facing will decrease a lot, right? Whereas first home buyers in that sub 750K budget, I think they're going to get absolutely wrecked, right? The reason being is, like, and we don't even need like data to show this, just like anecdotal evidence from ourselves as a business and the 50 to 100 other buyers agents we've spoken since the budget came out. We're on phones with all the, like, you know, people in the industry, friends, colleagues, you know, like literally tonight there's a buyers agent awards ceremony that we're going to. We'll probably catch up with another 15 to 20 buyers agents. And for majority of them, the investors haven't said, I don't want to invest anymore. They've just said, okay, I was going for a 900K budget, but now my borrowing capacity has changed because of the negative gearing changes. Or if their borrowing capacity hasn't changed, their cash flow has definitely changed. So now they're like, okay, let's not do 900, let's do 650, let's do 700. So there's heaps of people dropping their budget from that 700 to 1 million to the 400 to 700, right? So there's going to be a lot more competition in that space. So I actually feel bad for like most first home buyers are in that price range, right? Anyway, I think that's one of the outcomes of negative gearing, right? Another one is I think you're going to see a lot more people push towards higher yield deals, right? Or if they have strong cash flows, you're going to see people push very much to deals where there's an ability to create yield, right? So it's like, you know, where we're literally negotiating on a couple of deals right now where the deal itself is not great yield, but we're going to put a granny flat on there in the first 12 to 24 months.
Exactly.
So, you know, we've just told the client, look, first 12 to 24 months, absorb the cash flow. You know what I mean? It's going to be a little bit brutal. It is what it is. You'll claim those losses later, but we're going to put a granny flat in there, maybe even build a second one at the back, and then the cash flow is juicy, right? But so properties where you can create yield, like yield value adds, right? I think those are going to be huge,
absolutely,
right? And then number two is actual higher yield deals, right? Townhouses, villas, units. I think these were already starting to pump in the last 8 to 12 months, right? And these, I feel like these get a lot of hate, but in the right market, if you bought a unit, honestly, I think even if you bought like a 1 bed, 1 bathroom unit, which us as a business, we almost never buy 1 bedroom, 1 bathroom units. But if you bought a 1 bed, 1 bath unit,
it's like the black sheep of
But if you did that in Perth 4 or 5 years ago, you would have made 100%, right? So it's not
a really good price point,
and the yield probably when you bought it would have been like a lot.
Exactly.
It would have been like 7%, right? So I think these yield deals are going to see a lot more demand because people now need to balance the cash flow, right? We'll get into new builds shortly, but in the established space, is that like from all your talks with agents since, what are agents saying about the demand for different types of deals?
I would say yes, 100%. It reflects exactly what we're talking about. From my conversation with agents, there has been a bit of a dip in demand in terms of like investors looking at, you know, the type of stock that you're referring to. But that's just because of the uncertainty. I think it will start picking up again. But I think there's going to be a shift. And I'm seeing, like, obviously we've got our dealers team, the sourcing people. I'm seeing them sending us more and more sort of new build properties. And so they're already caught onto the wind here. So I think there's going to be quite a big shift, obviously, towards new builds in that price bracket. But the problem is with new builds, most of the stock is going to be at that price point. It's going to be in the outer suburbs, right? So you're going to have much more, obviously, that supply risk, number one. Number two, you're going to have, most likely than not, and most of the areas I'm talking about, like, for example, Melbourne's West, etc., has really high vacancy rates. The yields aren't that great. But I think, as we said, that will change. For established, I think it's probably going to be a little bit more of a easier playing field for first home buyers. But the key thing with negative gearing that's going to make a difference for our clients, for the most part, is, number one, it changes the, how you can maintain that property from a cash flow perspective. And then secondly, what kind of assets you're going to select, right? So that's going to make a massive difference. So I think from like a established market perspective, there's going to be a bit of a dip, but I think it's still going to increase because all these first home buyers are going to come into the market. And the key thing is, and from a property investing 101 perspective, we will never buy in markets where the majority of people buying are going to be investors, right? Or the majority of people that hold assets in that area are going to be investors. Why? Because investors are much more numbers focused, whereas home buyers are emotional. So we let the home buyers lead the market in terms of the price growth, right? So all those factors that we look at, like affordability, the demographics, the socioeconomic background of people, etc., all that plays into the same, equation, and that growth will predominantly come from the first home buyers. And now that they're all emboldened, it's going to
especially at the
anyway.
affordable price. And it's like once you have first home buyers and investors competing with each other, it just pumps, right? And it's like, I think a lot of that dip in demand is just uncertainty, right? Once
interest rates,
like people are just like, what is Iran war, this, that, all this stuff happening, right? Once that uncertainty becomes normalized, right? It's like then, okay, like a lot of people get back into the market. And the reality is, at the end of the day, the simple equation is there's just not enough houses for the amount of people, right? Like the gap between new people coming into the country, existing population growth, right, is there's not enough houses being built, right? And they're trying to plug that gap, but all of this, it doesn't plug that gap enough, right? And as a result, that's where the property growth comes from. Now, I think I agree with that on established. It's like we're going to see higher yield deals play really well. You want to ensure that you're buying in markets or yield value add deals. You want to ensure that you're buying in markets where there is good home buyer demand on top of that as well, so that after the first wave of growth that comes from investors is done, it doesn't stop growing. There's continuous growth through home buyers, right? I think that's super important when it comes to established, right? Now, when it comes to...
So I guess the crux there is, while you're copying it on a negative gearing perspective and you're not getting the benefits of that, the cash flow is going to be a little bit more difficult. Your capital growth will still continue.
Exactly. It is still... Like, because when you look at the profitability, you still get that money at the end, right? It's like, okay, instead of getting 4K back each year, you get 40K at the end. Now, so the profitability, I mean, there is the deflation perspective. So it's not as... Like, broadly speaking, it's... quite similar in terms of profitability. The main loss is a deflation and opportunity cost loss, right? When you're looking at it from a negative gearing perspective, not taking into account the capital gains component, right? Now, the major difference that this makes is it's a cash flow management issue.
Yep.
If you're just buying one property, right, it's like, okay, it is what it is. You buy your one property, you take those losses yearly, and then you get that money at the end. But if you're trying to build a portfolio, you're trying to make 1 into 2 into 3 into 4, right? Cash flow management is the most important thing, right?
That's the strategy.
I was on a call yesterday with one of our clients, and I said the phrase, like I wasn't even thinking when I said it, but I said it and I was like, I should say that in the podcast tomorrow. Scalability comes from sustainability, right? It's like, that's actually deep.
That's
you know
cool,
what I'm saying?
bro.
That's like, but
I like that.
it's like, and that's the reality, right? Like, again, at the end of the day, if you're like making, 2 million, right? Okay, it's not as much of a problem, right? But it is a problem. It eventually becomes, even if you're making 2 million income, it eventually becomes a problem, right? But if you're someone who's like, you're at home, your combined income is 250K, right? You need to ensure you're managing your cash flow for property 1 to become 2 properties, for 2 properties to become 3, right? Like, that is super important. You don't want to get to a stage where you have 2 and you're looking at your equity position, you got the equity to buy another one, you even got the borrowing capacity, but you look at the numbers and you're like, we actually can't manage another property from a cash flow perspective, right?
It's going to, and because of that, it's going to make those markets that are solid yield quite concentrated. Demand's going to increase for those because investors are going to flood there. And if they happen to be in, and they're most likely going to be in suburbs where first home buyers are trying to participate in, there's going to be a disproportionate. Now it's like as if they've taken the heat off of areas where there's low yield, like the government with what they've done. They've taken the heat off of areas where it's already kind of low yield. And they've put the heat on like triple on areas where it's high yield. And now if there's first home buyers, which there's going to be, because we are only playing in areas where home buyers are active, because that's what drives the growth, that's going to be even more competitive. So that's that. Then let's talk a little bit about the specific strategies that people can take. So now we mentioned, I guess, the short-term sort of negative cash flow tolerant people that can then go and create a value add. So, purchase a property, let the growth happen after between 1 to 3 years, depending on how much it grows, take out the equity, chuck a grand flat on there or some sort of other value add, and then get a good high yield asset. And obviously you're probably not going to be positive or neutral, but you're going to be quite minimally negative cash flow.
If you're going like 100% LVR, like, it might be hard to get to neutral, but you'll be very close to it.
Exactly.
Like, who knows?
It makes it comfortable, right? It makes it more comfortable to hold. So that's one. And that allows you to play in established markets, right? And you don't have sort of those risks that are related to...
I think like that's the ideal strategy.
That's the ideal strategy.
But the reality is...
the stock for that is extremely low.
It's not even the stock. I think the bigger thing is just like, most people don't have, like, those properties, the budget is higher, and most people don't have the cash flow tolerance for that. They don't have the buffer. Or not most people, but most younger people. Right? Like, if you're probably like middle-aged, higher income, you're a doctor, you're already a specialist.
Exactly.
Do that, right? That's the like.
And
that's
we're probably
what you're
talking
do,
about like
right?
What's the budget range we're talking about? Probably like around 800-ish.
I'd say like at minimum 700. Like we did one recently for 690, but that was like unique, right? Like
that was just like as interest rates increased,
it's like
the agent was from a different suburb.
It's like probably got at 100K discount, right? 100%. Like great deal. But I'd say like you'd be looking at a minimum of 700K, probably in.
Depending on markets.
Depending on the market,
like in Perth, you're probably going to be more.
Perth, you're probably
plus,
like
900.
honestly, I'd say like minimum 850. Looking at that, probably like 900 plus these days, even. Right, Brisbane's just crazy. So, it's not forget about it, but it's like it's a higher budget range. 100%. That's the ideal strategy. I think for your lower budget people, it's like we're gonna see those yields pump, or those yield deals pump. So I think that's super important. So let's jump into talking about new builds. Like, just realized that we're actually already around 40 minutes into this podcast. It's gonna be a longer one, but I think hopefully everything so far has been useful. So with new builds, it's actually interesting. I think in our industry, like the buyer's agent, property investment advisory space, I'm seeing two people. I'm seeing like some people who are like, they've completely changed their branding and they're like, new builds is the way to go. Established properties, dead, stuff like that. And then on the other end of the spectrum, I'm seeing people who are like, if anybody is buying you a new build, they're basically Satan incarnate. They're the devil. They're trying to scam you.
Yeah.
The reality is, it's somewhere in the middle, right? I think overall, we still have a preference for established.
Yeah.
But it's not to say that there isn't a place for new builds, right? Now, I guess quickly categorizing what a new build is.
Exactly. Yeah.
House and land packages, off the plan properties, new properties that have been built and are lived.
So near complete or completed less
within
than
12 months, right? So I guess those are the three main categories.
Yeah.
Now with new builds, I think there's two main markets, right? There's your new estate markets, right? So you can think of like Clyde in Melbourne, you can think of Leppington in Sydney, you can think of I'm trying to think of Brisbane, maybe like a Yarrabilba. Adelaide, you go to Munopara, Yanchep in Perth. Like I know my markets, baby. But I think with those, the reality is property growth is a demand to supply ratio, right? So you just have to look at that, because there's this assumption that new builds in new estates don't grow. But if you look at Brisbane house and land packages, Adelaide house and land packages, Perth house and land packages over the last 4 to 5 years, they did grow quite significantly. Maybe not as much as established, but they did grow quite significantly. So I do think you'll see certain new builds grow, right? Or these new estates grow. What you need to look for is new estates where the supply is comparatively low. It's not going to be low compared to an established area, but is it much lower than other new estates, right? The second thing is anything special about that new estate, like a school zone or something? But I think the biggest thing is, what is the demand, right? Because I think the absorption rate, right? And how many other new estates are there available? So I think you take an example, to me a good example is like northern beach suburbs in Perth, right? There's very little coastal real estate available. So it's like, while there's a decent amount of new builds coming on, one, Perth is a very slow building rate because there's not enough builders there.
And it's a difficult soil to work on there, because a lot of it is sand on those northern shores.
Exactly. Number two is it's coastal, so there is a desirability for it, right? And number three is just around Perth as a whole, there's not much new estates compared to like Melbourne, right? Like Melbourne is like a new estate central, you know what I mean? So if you can find a market, and we're not saying that that's a good market, that's just an example of a specific mechanic. You need to run the
supply
data,
constrained,
right?
Naturally,
But I think it's all about absorption rate, right? It's like, if you can find a new estate where the absorption rate is significantly higher than the supply, even though the supply is high compared to an established area, you'll still get growth. I don't think the growth will be as significant as established areas, but at the end of the day, if having that allows you to,
that's your only possible
path, if it allows you to better manage your cash flow, right, and that allows you to buy a second property, right, like if you have two 800k new properties that are growing at 60%, it's better than one 800k established property growing at 100% per year. Not per year, per every 10 years. 100% per year is like
on the ultimate journey.
Exactly, right? So it's that strategy, right? But I do think in new estates, you really need to do your research. I think Melbourne new estates are probably going to perform the weakest, because there's so many new estates in Melbourne. Maybe there's a couple that I could see, having a decent absorption rate, but out west, out deep, far southeast, you know.
You wanna be in areas where, and we've obviously reviewed quite a few deals now that we're looking at this strategy for clients. You want to be in areas where there is that natural geographic constraint as well.
Exactly.
Look, for example, in Cairns, there's some deals there that they're just literally limited by the rainforest.
Exactly.
The
it's
lakes.
Like they're not going down. They're going. Exactly. They're chopping the forest in like Bentley Park, right?
So it makes it more difficult to access that land for supply. So and then I think the other two options. So you're off the plan, and off the plan houses are quite rare. They come,
and off the plan houses, you actually don't get if they knock down one house to build one house. On the current model, you don't get negative gearing.
And also the stamp duty is much higher because when you purchase a house and land, you're paying stamp duty on the land, and then you
Yeah.
construct,
Whereas
which
over
the
here,
value
you're
of the
buying
land
house,
alone.
yeah.
Exactly. So
Yeah.
your stamp duty cost is going to be higher on off the plan. So probably that's a
Or like
thing
single
to
off the
deal.
plan. Yeah.
Exactly. So off the plan, townhouses, potentially even for people who are quite constrained on budget, potentially even units on smaller mid-rise sort of blocks. Something to think about if you've got a really low budget. But the townhouse off the plans and your newly almost constructed new builds or new builds that have been constructed for less than 12 months essentially, those are going to be quite strong as
I
well
actually think
in
those
terms
will
of demand.
pop off,
But the supply there is extremely low.
Yeah.
Right? Supply there is extremely low
Yeah,
for those.
I think if you go to a suburb with a really high owner-occ demand, not just for houses, but for townhouses as well, right? And you buy something near completion, you get the negative gearing benefits. The homeowner demand will pop off in those suburbs. We're looking at a couple of deals in like Morford Vale, Christie's Beach, those areas, right? In the 700s, close to 800, right? Townhouses, 3x2s. These are things that like have like high quality builds. These are things that have desirability from home buyers. You get the negative gearing, you get the depreciation, you get the cash flow. Again, will it perform as well as an established? Probably not, but it will perform well, right? And
especially because of the new playing field.
Yeah, it will perform well, and your cash flow will be a lot healthier, which might let you buy a second one.
Exactly.
Off the plan apartments, I feel like the jury's still out. I feel like the reason for me it's like the thing over there is you could just buy a built apartment where the yield is so high that it's almost that you don't really need the negative gearing. It's already close. Like we got a deal the other day. What was it? Like low 300Ks in Metro Melbourne, renting for like what 520. Right. That's going to be pretty close to neutrally geared. So you don't really need you don't really need
strategize for the negative
negative gearing, negative cash
unless
flow,
unless you're buying this like a blue chip sort of area, which if you do that, your budget's going to go up in any case.
Yeah, exactly. I think the long story short of it is it really just depends on your strategy, your cash flow, your goals. And that's always been the case. But I think after this federal budget, that's even more important, the entity you buy under,
100%.
all of that kind of stuff. I do think there is a place for new builds in certain portfolios.
100%.
I do think established should still be the primary goal, purpose in most people's portfolio, the primary.
If they can achieve that.
If they can achieve that. But it's not a no-no. Now, with new builds, there's a very different layer of due diligence,
100%.
analysis, market analysis. We're not going to talk about that now.
No.
That's going to be a very long podcast. I guess the good thing, we should actually do another episode on that. Maybe next week before I'm off, overseas. But I think that's super important. The good thing from our perspective as a business is, a lot of buyers agents, they're like, they haven't done any new builds and now they're on the phones, whatever. For us, we weren't really doing much for our local clients. But for those who don't know, people without an Australian citizenship or PR, they can only buy new builds, right? So we have a lot of those connections, and as a result, we have already built that infrastructure.
And maybe to the point that you made just earlier about like people in the buyers agency space, property space, saying, "Oh, these people are charlatans," or "These people are." If you buy a new build, you're a charlatan, or like the people who are like, "New builds are the best thing in the world." I would just say, do your due diligence as well, because not all new builds are created the same, just like how not all established properties are created the same. And the key difference there is there may be a conflict of interest with some people in the market, because off the plan house and land developers, they pay big bucks for people, and it would be great to cash that in for ourselves as well, but we are taking the priority of the client before we're taking any of those conflicts.
Our pricing model with new builds, I'm not going to jump into it now, but for anyone who's interested, our pricing model with new builds
is to prevent conflict of interest.
Exactly. And I think that's important. I did want to talk about commercial property, but I think we're going to leave that for a separate podcast. I think the
crux of it is commercial property is going to be there's going to be a really big push to commercial property in the
Gonna
short
perform
term.
well.
Yields are going to be compressing quite quickly. So there's going to be a big rush towards
Yeah,
commercial property. And it's
definitely.
going to be very, very attractive for people who are looking at, scaling a portfolio over sort of a short-term period to just go in and just lock a commercial property in for themselves. And that's going to reduce sort of your accumulation period more generally, but it might be like in this short-term, mid-term time frame, it might be one of the best strategies as well for those who can.
I think for those who
play in
have
that
the
space.
capital, you know, if you got a decent amount of equity, looking at lease stock loans, negative gearing is still there for commercial property. We're actually working on quite a few commercial clients right now. You've been in the commercial space for heaps of time.
I'm a commercial real estate lawyer, so
commercial real estate lawyer. We've got our head of commercial, who's an absolute beast. But I think let's leave that for a separate episode.
Cool.
Let's finish off just by talking, I guess, maybe a little bit of a motivational piece,
Yeah,
right?
I think there's a lot of information out there. There's a lot of, there's a lot of guesswork as well. Like, what's going to happen to property investing? Am I still going to be in the right position or not? Am I going to have the advantages that my previous generation had? And also there's going to be parents who are going to think about, how can I make sure that my children can still take the advantage of what I've created as well in terms of wealth creation and allow them to grow as well. So there's going to be a lot of uncertainty, but I think still, and you can tell me what your opinion is as well, but I think still to this point, with the new playing field we have, property is still one of the best, if not the best, wealth creation tool in Australia, despite the changes that have happened.
Oh yeah,
in the federal
100%.
budget.
It's
Simply because, and I'll just make it short and sharp, simply because of, number one, leverage, and number two, the data and the broader macroeconomics of property in Australia. And everybody is involved in property in this country. So I don't see it replacing any other asset class in any major way from a low risk perspective. Especially, actually, this is a curious one because the government, they changed the CGT, obviously discount.
Yeah, we hardly even talked about CGT.
Yeah, we hardly even talked about CGT, but the crux there is there was some talk about exempting non-property assets, and I feel like now that everybody is affected by the same CGT
There's
changes,
no major opportunity
yeah,
cost.
there is no major opportunity cost. In fact, it probably hurts younger generations again because if you were saving up for a deposit by putting money into an ETF, for example, you're going to be taxed because that investment is more so a short-term investment. So you're going to be taxed even more on that, right? Because it's a short-term investment, and the benefit of the indexation is long-term. So again,
it's like they're killing us out here,
Yeah,
bro.
man.
Gen Z, new migrants. It's like basically it's game over for it's not game over. It is a little bit harder. The rules have changed. What is achievable might not be as much as it was 5-10 years ago, 15 years ago. That's just the reality. But that doesn't mean you do nothing, right? You can we still have, like, I think this last 3 weeks in this last week, I've had like 3 clients where we've done their long-term plan and they'll still achieve their goals, right? Maybe their goals have been moderated a little bit, right? But it's still, you can still achieve a lot of your goals and build a long-term portfolio and, pay off your home debt in your hopefully late 30s, early 40s, start to acquire assets that are bringing you closer to your retirement by your early to mid 40s. That's, at the end of the day, that's what everyone's looking for. Lots that we didn't cover. I do think we should maybe do another one, talk about
we didn't talk about inheritance tax.
Yeah, I think they should have done an inheritance tax. I don't know. I'll probably get roasted, by everyone for saying that. But they should have done some sort of a residential property inheritance tax above 5 million. That's the university.
This whole intergenerational fairness is just
that's like the university socialist in me saying, But let's tie it off there. thanks, Nirvan. I don't really need to say thanks. This is your own podcast as well. But thanks everyone at home for watching. Thanks for jumping on. And if you ever need any help, just reach out as well. We're more than happy to have a chat. Talk soon. Bye.
Chat soon.